So you're starting to get a ton of coverage around the looming banking crisis and the credit tightening that may ensue as a byproduct of that banking crisis. What you're probably not getting much of is a breakdown on how that can work, something material that you can use to help defend yourself against this tightening that is happening in front of our eyes and will continue to happen for the foreseeable future. So what does it look like when banks are in crisis mode and they are limiting their risk? What does it look like? What type of practices come into play to limit credit? Is it just arbitrary? Do they just start to randomly decline clients? Do they just pick numbers out of a hat? Or is there a process, a system? And if so, is this something that you can defend yourself against? We're gonna cover it in this video. This is JP from Blueprint for Prosperity. We're gonna get right into it. So when you're dealing with the banking crisis, what's basically going on in the simplest terms is that the economic environment is not sustainable for banks' normal practices and their financials are becoming strained. So in this scenario, without going into specifics because it's not as relevant in this video, but in this for circumstance, banks are experiencing a circumstance right now where the environment is harsh for them. Certain practices that have worked for them over the past 5, 7, or 10 years have now changed almost overnight, essentially, with higher interest rates that has came faster than they could adjust to, okay? So with this being the case, now you have to deal with the fact that banks are gonna be a lot more leery about risks that they're taking. And in the process of doing so, that means that they are going to limit the amount of credit that they put out to certain clients, certain customers, certain applicants. I want to make something abundantly clear before we dive into this further. Banks are not going to stop lending altogether. They're not able to do that. They have no incentive to do that. Literally, the bread and butter of a bank's business is lending. So I want to dispel this idea that banks are going to just close their doors up or cut their lending by some dramatic percentage and stop approving people. They still have a business to run. They still have an operation to run. Banks will lend. What we're going to deal with in this banking crisis that most in the mainstream and even the alternative media are not going to cover is that they're going to pick and choose to the best of their ability who they're lending to. So it's not going to be a tightening or a lending crisis for everybody. It's absolutely not. We're covering that in this video. So what happens when banks tighten? What are they going to do? What does that practice look like? Well, the first thing is the obvious thing that most of you are probably thinking and that you've heard in the financial media. They're going to raise the bar. Whatever thresholds that used to be there for a lot of their lending, they're going to find different metrics that they can up the ante on. They're going to up the requirements for. So whether that's mortgages and changing the DTI ratios, if it's credit cards and changing the minimum credit score or DTI or whatever the case may be, or having too many new accounts, they're going to find these different avenues to close the door or at least raise the threshold higher for you to cross. That's the first thing that's going to, first form of tightening that you're going to see. This in itself is going to weed out tons of people, tens of thousands, if not hundreds of thousands of people who may have been qualified to get approved for something, a different loan or credit product, 6, 12, 18 months ago, may have a harder time doing so now, okay? So that's the first thing. They're gonna raise the bar. The next thing that's not so obvious that you are not gonna hear almost anywhere else is banks are going to scrutinize the loan more. It piggybacks a little bit off of the first point that I just made, or the first tactic or strategy, but this goes on a different trajectory. They're gonna scrutinize your application a lot more if they have the infrastructure to do so. What that means is the answers to your applications may not be as fast. What that means is they may start to get tedious about indiscrepancies on your credit report or indiscrepancies on your financial records that they normally may not pay attention to if money's flowing freely, if credit is flowing freely, okay? So what that means is you may have an indiscrepancy on addresses, employers, your name, social, your, what you put down as income on your application versus what they're seeing in another reference point. Any indiscrepancy that they run across, they're now going to fine-tooth comb through and scrutinize you for. This is going to be the bread and butter of credit tightening, the credit crunch that you're hearing about. It's not going to be an arbitrary denial situation, because there's legislation around these things that keep people from being able to get denied just for no reason. Banks have to, by law, give you valid reason why you didn't qualify for their product. That manifests itself in the form of an adverse action letter. And what that basically is a statement that tells you what report they pulled from, what data sources they pulled from, what they found on your information that disqualified you for that product, right? So what I'm telling you is, banks are gonna find these little mischievous ways to weed out a bunch of people who don't pay as much attention to their personal information or financial information, or may not just be aware of the indiscrepancies in their information. They're going to give them hell. Meanwhile, those who are on top of their finances, who have really strong credit profiles and very strong banking relationships, if the lender you're applying for is also a financial institution and not just a lender, when you have multiple products, they are going to feel more comfortable and see you as less of a risk when they have a broader financial picture on you. This is the lifeblood and the value of relationship banking, something that is extremely underrated in our financial system. People have no value on average building an entire relationship with an institution except the wealthy. They get it. Most of you that are watching this video probably don't. And that's why you need to tune into this channel, because I'm teaching you all about why you need to build out relationships with these institutions and not just arbitrarily try to one night stand them or, date them off and on. You have to build out a full relationship with these institutions, because times like these, it reigns supreme. Credit profile is polished, credit score is high, and I see multiple different avenues where you're responsible with your money and you're responsible with my money. So as a lender, I feel comfortable with you. So these people are not going to experience a credit crunch. They're going to get the high limit credit cards. They're going to get the high limit business funding. They're going to get the flexible terms on home lending. They're going to get the gambit. Auto loans, they're going to get the best rates. Why? Because banks are seeing them as an opportunity where they have to cut off the subprime borrowers. They have to make up for that profit in some form or fashion. Let's broaden the credit. Let's broaden the availability to our reliable borrowers, to the people who have strong financial profiles and relationships with us. Let's give them more money. We have to continue to bring in revenue. We have to keep making profit. We have shareholders that still have expectations of us. So we have to find a way to get this money out here one way or another. We can't trust or take the same level of risk with subprime borrowers. So what we're going to do is simple. We're going to broaden and expand, close the door off to more subprime borrowers, close the door off to people with indiscrepancies on their financial records, and open the door broader to those who we can trust, that we have history with, who have strong relationships with us. Pristine credit. Position yourself properly. Strong banking relationships, strong personal credit. If you can, build your business credit out. Put all of this in your favor. I assure you the door will be wide open for people who meet these criteria. If you do not, if you're not paying attention, if your personal information is off, if your credit profile is not that strong, if your income is not steady and stable, if your debt to income ratio is out of whack, you will suffer in the coming months and years. If you check those boxes properly, the floodgates will open, because these banks and lenders have to lend to somebody, and they're going to make sure it's the best qualified borrowers. I appreciate y'all tuning in. It was really important for me to bring this content to you, because there's almost no clarity out there on how this works. So hopefully this video gets out there over time so you can make the proper adjustments with this new information and position yourself, because I'm telling you now, the floodgates will be open for those who qualify, and the door will be closed, or the mountain will be that much higher to climb if you're not in position. As I said, thank you for tuning in. I enjoy bringing you this content. To all my pioneers out there, I want you to stay focused, stay in motion. I'll see y'all soon.
This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.